Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look at inflation and the impacts of inflation, what asset classes do very well. Got a nice good chart that I was reading in an article that I'd like to share with everybody. So let me read some stuff here and go into some of the assets that perform really well and the probabilities of them performing well under inflationary conditions. Also, I'm going to go over rent prices. Rent prices are going ridiculous. They're up double digits. Some states are averaging like 20, 30%, right? Rent price increases year over year. So expansion phase of real estate, you go short on homes, then the rent prices go crazy. And that's exactly where we're at. We're at rent prices going crazy. We're at maximum shortages of new homes in the market. So we're at the maximum shortage of homes in general. So let's go over all that. First, I'm going to read the 5-year inflation expectations as measured by the yield difference between nominal and inflation-protected U.S. Treasury bonds have rebounded sharply from their pandemic lows and are now at 2.5%, their highest level since 2008. So looking at the 5-year inflation expectations, they're the highest levels that they are now since 2008. Moderate inflation is generally good for equities because it tends to be associated with positive economic growth, rising profits, and stock price gains. And that's with positive economic growth. However, things can turn ugly for the stock market. Investors, if the economy overheats and inflation rises too high. Our research has found that equities outperformed inflation 90% of the time when inflation has been low, below 3% on average and rising. And that's your recovery phase of real estate. Now, what I have above, what I'm going to show you in the chart is it's illustrated. The x-axis shows the percentage of rolling 12-month periods since 1973 when equity returns exceeded inflation in high and rising inflation environments. A measure of how consistently each sector has beaten inflation in these environments. And the y-axis shows the inflation-adjusted return. So inflation-adjusted return, and this is the probability of beating inflation, and these are the different sectors. Let me zoom in on this, just see if you guys go back here. So U.S. equity sector performance. What we want to see is we want to be in the upper right-hand corner over here, where we have a very high adjusted return with a high probability of beating inflation. Energy is in the far right. That's where we're at. Equity REITs do pretty well, and same with precious metals and mining, but they only beat it a certain period of the time. A lot of precious metals do very well in a reflation right in the beginning. They do poorly in the middle, and then they do really well at the end. So we're kind of in the beginning, and we're right where precious metals and mining, they kind of lag a little bit, and then eventually they start kicking up and killing it. Energy does pretty well during the whole boom in the beginning. So energy is the most reliable under inflation in terms of the probability of beating inflation, but so are precious metals. They'll do just fine. You don't want to be in mortgage REITs, IT, telecoms, U.S. equity market doesn't do very well in a high inflationary environment, and the returns are actually negative. So anything under here, you don't really want to be in here. You want to be up top. I also have in here, it says on the right-hand side, it says, in practice, the impact of inflation on earnings will vary by economic sector and its ability to pass on higher input costs to end consumers. But as long as input costs do not increase at the same rate as revenues, the rise in profit margin should translate into greater nominal earnings. The problem is that the market will often discount those future cash flows at a higher interest rate when inflation rises, to compensate for the fact that they are worth less in today's money. All else being equal, the higher the level of inflation, the greater the discount rate applied to earnings, and therefore the lower the price to earnings ratio investors are prepared to pay. And we can see that relationship with the PE ratio on the y-axis and the interest CPI inflation on the x-axis. We are at this region in here, and our PE ratios are way up here. So usually what happens is this will contract down and we have a stock market crash if we're in this general vicinity of where we are today. we would have a stock market crash. More than likely, they're in there buying assets and buying stocks to prop everything up with printed money. That's probably what they're doing. So they're holding this whole thing up, and we have a favorable currency at the moment. Now, looking at rent, I want to swap and go to rent. So what we got here is the rent report, December 2021, the state of the rental market. It was published yesterday. The national average rent price, look at this. Nationwide, rent prices for both one-bedroom and two-bedroom apartments have increased significantly year over year at 21.3% and 16.7% respectively on a year-over-year basis. The state average rent price trends. So a one-bedroom, 97.8% of states are up, and only 2% of the states are down. Two bedrooms, 100% of the states are up, none are down. They're all up in rent prices. Now, Montana doesn't have any data there, neither does West Virginia. But looking at this, we have some aggressive year-over-year changes on, this is what I have is the two-bedroom. It's up 32.75% for Oregon. We're up 32.27 in Florida from 1,700 to 2,257. That's very fast. I'm in Colorado, 12.5%, Minnesota, 14, South Dakota, 23.6, Utah, 21%. Let's look at the one bedroom. This is the one bedroom. Holy moly, 58.8% average rent for one bedroom in Oregon. Almost 40% in Florida, 38% in Utah, 45% in South Dakota, 33 in Kansas, 37. Indiana, way to go, and Wisconsin, way to go, just under 2%, so that's pretty flat. But I just wanted to touch on the rent prices, and these things are rocketing higher, guys. They are smoking higher. I mean, 45%, 30%, 20%, that's ridiculous in 1 year. We have a huge home shortage. It's pretty obvious when looking at anything. So you guys should be pretty, I should say, confident in the home prices moving on up, and with rent prices going up, this is just going to entice people to go buy. So I don't see this stopping until we build enough homes and enough apartments and enough places to live. So it's probably going to go on for a little while, and we just have to be patient with our investments because they're going to work under these market conditions. I do think with the high inflation that stocks are going to come under pressure, as seen with the PE ratios and the net present value calculations that they'll get when discounting with higher interest rates. And I think we're in the right locations if we're going to have a highly inflationary environment in energy, precious metals, and some of the materials. If you guys like this analysis, give me a thumbs up, subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.